This is a 1-minute scalping strategy, which is a fast trading method focused on taking small, quick profits from short-term price movements. The strategy starts by identifying the overall trend because scalping works best when trading in the direction of the market, either upward or downward. Once the trend is clear, the trader looks for a precise entry on the 1-minute chart, usually after a breakout or a simple price pattern that confirms momentum. The stop loss is placed very close to the entry, often below the most recent low or high, to limit losses and protect capital if the trade goes wrong. The take profit target is also small and quick, typically set at the next resistance or support level, allowing the trader to exit fast with a modest gain. A key part of this strategy is risk management, where only a small percentage of the account, usually between 0.5% and 1%, is risked on each trade to avoid large drawdowns. Overall, this strategy relies on high-frequency trading, fast execution, and strong discipline, making it suitable for traders who can focus closely and make quick, controlled decisions. How to refine entries for a 1-minute scalping trade by combining the 5-minute trend with precise 1-minute execution. The process begins by confirming the main trend on the 5-minute time frame, which represents the bigger picture. If the market is making higher highs and higher lows, it confirms a strong uptrend, and traders should only look for buy opportunities. This step helps avoid trading against momentum and increases the probability of success. Once the overall direction is clear, the trader shifts focus to the 1-minute chart to time the entry with precision. On the 1-minute chart, price usually pulls back into a support zone, which was previously a resistance level. This pullback is healthy and expected in a trending market. The actual entry is taken when price shows a clear bullish signal, such as a bullish engulfing candle or a strong rejection candle from support, indicating that buyers are stepping back in. Additional confirmation comes from the RSI indicator, which should be near or below the oversold level and starting to turn upward, often showing divergence. This combination of trend alignment, price action confirmation, and RSI support creates a high probability long entry. Overall, this method emphasizes patience, accuracy, and discipline, allowing traders to enter quickly with confidence while keeping risk tightly controlled. The difference between buy and sell trading setups in a simple and practical way. In a buy setup, the trade is taken when price reaches a support area and shows signs of reversal or a strong bounce upward. The entry is placed slightly above the confirmation candle, the stop loss is set below the recent low to control risk, and the take profit is positioned higher, where price is likely to face resistance. This ensures a favorable reward-to-risk ratio, meaning the potential profit is greater than the possible loss. In a sell setup, the logic is reversed. The trade is taken near a resistance area, where price shows rejection or a bearish reversal signal. The entry is placed below the confirmation candle, the stop loss is set above the recent high to limit risk, and the take profit is placed lower at the next support zone. Both setups emphasize clear structure, controlled risk, and disciplined execution. By consistently following these rules and maintaining a reward-to-risk ratio greater than 1-to-1, traders improve their chances of long-term profitability while keeping emotions under control. How stop loss and take profit levels are used in a 1-minute scalping strategy with kite risk and a clear reward structure. After entering a trade, usually in the direction of the trend, the stop loss is placed very close to the entry, often just below recent support or the latest swing low. This tight stop, typically around 5 to 10 pips, helps limit losses quickly if the market moves against the trade. The goal is not to avoid losses completely, but to keep them small and controlled. The take profit level is set farther away than the stop loss, usually at about 2 times the risk, creating a 1-to-2 risk-to-reward ratio. For example, if the risk is 7 pips, the take profit target may be around 14 pips. This means even if the trader wins only half of their trades, they can still remain profitable over time. By combining a tight stop loss with a well-planned take profit, this approach focuses on protecting capital, locking in gains quickly, and maintaining a positive trading expectancy. Discipline in following these levels is essential, especially in fast-moving one-minute scalping environments. How RSI is used as confirmation for quick scalping trades, especially on lower timeframes like the 1-minute chart. In scalping, the focus is not on long moves, but on fast momentum shifts, and the RSI helps identify those shifts clearly. The most important level is the 50 line, which acts as a momentum balance point. When RSI moves above 50, it signals bullish momentum, meaning buyers are in control and buy trades are preferred. When RSI drops below 50, it signals bearish momentum, meaning sellers are stronger and sell trades are favored. For scalping entries, traders wait for RSI to cross and hold around the 50 level, confirming direction before entering a trade. In an uptrend, RSI pulling back and then turning up above 50 supports a buy entry. In a downtrend, RSI rising and then turning down below 50 confirms a sell entry. The overbought and oversold levels, such as 70 and 30, are less important for scalping compared to momentum around 50. Overall, RSI is not used alone, but as a confirmation tool alongside price action and trend direction, helping traders enter faster, avoid weak setups, and capture small but consistent profits with better confidence. A real example of a 1-minute scalping trade on the Euro-USD chart, putting all the previous concepts together in a practical way. The trade is a buy position, taken after price pulls back and shows signs of support holding. The entry is placed around 1.1050, where price starts to stabilize and buyers step in. Below the entry, a tight stop loss is set at 1.1020, just under the recent low, to limit risk if the market moves against the trade. This tight stop keeps losses small and controlled, which is essential in scalping. The take profit is placed higher at 1.1100, targeting the next resistance area and creating a favorable risk-to-reward ratio, where the potential profit is larger than the possible loss. The volume at the bottom helps confirm participation, while the candle structure shows a short-term shift in momentum. This setup demonstrates how scalping focuses on quick entries, tight risk, and fast exits, rather than holding trades for long periods. By following this structured approach, clear entry, defined stop loss, and planned take profit, the trader removes emotion and relies on discipline and consistency to capture small but repeatable gains in the market. A complete 1-minute scalping buy setup, combining trend, structure, entry, stop loss, and take profit into one clear example. The market is in a strong uptrend, confirmed by higher highs, higher lows, and price staying above the moving averages. During the uptrend, price pulls back into a previous resistance zone, which now acts as support. This area is marked as the key decision zone, where buyers are expected to step in. The buy entry is taken after price breaks back above this zone with a strong bullish candle, showing that momentum has returned in the direction of the trend. The stop loss is placed just below the recent swing low and below the support area, keeping risk tight in case the setup fails. The take profit is set higher, near the next resistance area, allowing price to continue with the trend and deliver a better reward compared to the risk. This setup demonstrates the core idea of scalping: trade with the trend, wait for a pullback, enter on confirmation, and manage risk strictly. By using clear structure, tight stop-loss placement, and realistic profit targets, this method focuses on consistency and discipline rather than chasing large moves. It is designed for quick execution, controlled losses, and steady gains in fast-moving markets.